Good afternoon. I'm going to do just a very quick welcome to those who are already in the webinar and let you know that I'm going to give it another minute for more people to log on before I speak further. All right, good afternoon from the Philadelphia area. We have a packed agenda today, so I want to go ahead and get started, recognizing that other people may be still in the process of logging on. But I want to say welcome on behalf of the Villanova University Graduate Tax Program. I'm Joy Mullane. I'm the faculty director of the program, and we are so excited to offer this webinar today on the M&A Dirty Dozen, looking at a variety of issues from the perspective of sub C, sub K, and SALT issues. I'm particularly thrilled that we have amongst our panelists today both adjuncts and alums, and sometimes they are both. I am expecting this to be very enlightening. And with that, I'm going to hand this over to our professor of practice, Mike Sums, who's going to be moderating the program for today. And thank you very much for joining us. Mike?
Thank you very much, Joy. And I'm really excited about the presentation today. I'm going to just try to keep the trains on time as we navigate ourselves through what we're calling the Dirty Dozen M&A issues of sub C, sub K, and SALT. And like Joy said, we have a really terrific panel. We have Morgan Holtman, who's going to talk to us primarily about sub K issues. She's a partner at Hostetler in the Washington, D.C. office. We also have Debbie Martino, who is the tax director at Graham Partners. And Debbie is not only an adjunct faculty member, but an alum. Morgan is an adjunct faculty member. And we also have Nick Stratis, who is an alum and an occasional guest lecturer in the Grad Tax program. And we hope that with these types of webinars that we're able to bring to you certainly cutting edge issues, but presentation by people who are going to be sharing real life and valuable experiences that they have had in dealing with these issues. So like Joy said, we have a really packed program, so I'm going to get right into it. And as soon as I can move my slide, there's more information about our panelists if you'd like to get in contact with any of them. And actually, before I turn it over to Debbie to discuss our first issue, if you have any questions, please submit them in the chat box. We will try to address them to the extent we can. And actually, we look forward to that kind of interaction. We want to make this as valuable and meaningful to you as possible. As we know, in 2017, there was historic tax legislation at the federal level. We may be seeing another round of it soon. And even though that's our number one issue that we have here, you'll see that it really encompasses several of the other issues underneath it. So Debbie, I'm going to turn to you and ask you to tell us, give us an overview of some of the issues that are pending before Congress that could have impact on what was, it would be normally a busy time of year for M&A, maybe a busier time of year because of the pending tax legislation. People might be afraid that rates are going to be going up. Some of these other changes may cost them more money if they do a deal next year as opposed to this year. So maybe you could walk us through some of these and talk to us about what you're seeing.
Sure. Thanks, Mike. And welcome, everybody. So yeah, regarding tax legislation, there's a lot out there. There's a lot we do know, and there's more that we don't know. So I'm going to try and cover more of what we do know. At the Friday, November 19th, right, the U.S. House of Representatives passed H.R. 5376. It's the Build Back Better Act. And the vote was 220 to 213. Now, that bill contained a couple key provisions, some of which differed from the House Ways and Means proposal back from September. But to go over the key ones, right, that we're going to focus on here, there's a 15% minimum tax on adjusted financial statement income. And that's for corporations with a 3-year average income in excess of $1 billion. So that's one of the key proposals that, I know people are taking a look at and saying, what is that? It's essentially an alternative minimum tax. It's just meant to act very similar to the former AMT that was repealed with the TCJA. So it would be creditable from what we understand. But it is based on, financial statement income instead of taxable income being modified. Another key proposal that's in there is a 1% excise tax on the fair market value of stock that's repurchased by publicly traded corporations. Now, this excise tax, it would appear to extend to transactions that are treated as constructive redemptions for federal tax purposes, such as leveraged buyouts of a publicly traded target corporation. And furthermore, though, the excise tax should not apply to a repurchase to the extent that it's part of a rework within the meaning of Section 368A, where there's no gain or loss being recognized by the shareholder because of the reorganization. That's a little positive there. Other things in the tax proposals that we've seen, there's a 1-year delay in some of the effective dates of many business and international tax proposals. But on the international front, there were some modifications to tax rates for GILTI and FDII. So the FDII and GILTI section 250 deduction, the bill proposal shows that the global intangible low taxed income, GILTI, at 15% and the FDII at 15.8%. And the beat rate in the bill, that would increase the base erosion and anti-abuse tax beat to 12.5% for 2023 and 15% for 2024 and 18% for 2025 and thereafter. So what else is in the proposal, right, that we were focused on? There's, sorry, my screen has frozen. Bear with me 1 second as I navigate this.
While you're doing that,
Yeah.
Debbie, maybe I could ask you, I know you don't have a crystal ball, but how likely are some of these things to pass? And is it going to pass in this form, or is it likely to be changed?
That's a really good question. So we are seeing that, right, the Senate, that's where things stand now. We have to see what the Senate does with these proposals and whether they're on board or not. There's definitely not a lot of, we're not seeing a lot of enthusiasm for some of these proposals. And one thing to mention because of that. So, I've covered a lot of things that are in here, and there's a couple more that I'll get to, but what is not in here, and these are some of the things that might prevent some of the act being accepted by the Senate, is we didn't see a corporate income tax rate, right? So previously the House Ways and Means included a corporate tax income rate of 26.5%. So that's a big key, right? There's not a lot of appetite to raise corporate tax rates. However, we know that the House Ways and Means, did have that in their proposal. So it'll be interesting to see what the Senate decides to do, whether they want to accept what's in the House bill or whether or not they want to modify it further. We also didn't, go ahead.
I was just going to add, I thought I was on mute. From a partnership tax standpoint, I'll get to this in a minute. The November House bill that Debbie is describing actually is far more favorable than the Ways and Means release from September 13th. So I think there was an initial sort of cheer by partnership tax practitioners when the BBBA text was released. Though Senator Manchin, as we all know, and Senator Sinema have been, extremely influential in driving the direction of this legislation, so much so that I think we're beyond the point of seeing sort of discernible tax policy. And Manchin has said that he does not view the House bill as his starting point. So I think it just, as Debbie's saying, it's entirely unclear what's going to happen. But I suspect, for example, on the partnership side, some of the provisions that I don't love as much may find their way back into the Senate bill.
And I think we're worried about that on the corporate side as well, Morgan. Great point. And some of the other things that are in that House proposal that was passed in November, basically there's a delay in the mandatory capitalization of R&D expenses. So under TCJA, there was supposed to be a sunset, if you will. Currently they're deductible, but starting in 2022, those expenses are supposed to be capitalized. So the bill is saying, hey, let's continue capitalizing those types of expenses. The proposal also has a surcharge on high income individuals, estates and trusts. And that's pretty significant. So while it's not doing a mass tax increase on individuals, it is targeted to high net worth individuals that have income thresholds of above a certain level and the trust associated with that. And that, I'm sure, Morgan, you're seeing is affecting flow through entities. And I know that's what we're seeing is stemming a lot of the activity around the M&A transactions today because of the fear of some of these rate increases. Additionally, in the proposal, there's the application of interest expense limitations to partnerships and S corps, which Morgan's going to go into more detail. And then we also have application of net investment income tax to trade or businesses of certain individuals. And the principal effect of that proposal is that S corp shareholders, limited partners, LLC members over a certain income threshold who currently may not be liable for Social Security type taxes or net investment income taxes on their pro rata share of that type of income would now potentially be subject to that with this proposal. So there's a lot in that House bill. And like I said, what's not in there is that corporate rate increase. Overall, the individual capital gains and qualified dividend income rate increases, which we've seen proposed elsewhere, carried interest modifications are not in there. And I know something that Nick would probably be best to talk through is there's a late addition to the House bill, which was to increase the individual deduction for state and local taxes. So Nick, want to see?
Salt cap.
Yeah.
Yeah, good point. So we, back to TCA days, we had the $10,000 SALT cap, and I know there's a notice that came out from the IRS last year, and the states have started to pass what we call pass-through entity taxes, which are entity level taxes on partnerships and S corporations in many cases, where the deduction can be taken for that tax by the individual partners and S corporation shareholders, basically bypassing the cap. And so what we've been seeing, I think, in this legislation is sort of a debate between Senator Menendez from New Jersey and Senator Sanders from Vermont on whether and to what extent to raise the cap. And I guess we'll see how that affects any of these sort of state pass-through entity taxes as well. But definitely something that bears watching, especially for individuals that are paying more than $10,000 or $80,000 in some cases of state tax.
Yeah, and Nick and Debbie, isn't a big part of that particular issue, as with almost every issue, is what's the cost? And if they give that break forget about to whom they're giving the break, that's less tax that they're going to collect. That means they got to get something from somebody else, right? To put it
Right,
bluntly.
yeah, exactly.
So,
Definitely.
Yeah, but you have these, the senators that care about this the most are the senators in the states that have high tax rates, like New Jersey,
Right.
like New York, like California, Illinois. So they're the ones that are kind of pushing this down that path, I think.
mhm. No, that's great. Well, maybe we should turn, and thanks, Debbie, but turn to maybe the next couple of issues. And Morgan, maybe you could talk to us about carried interest, interest expense limitation. And even though they aren't necessarily directly sub K, and I think this shows how each of these issues has generally several dimensions.
Sure. Yeah, absolutely. So carried interest, that's one of the topics that Debbie and I both indicated that, there was, carried interest reform, if you will, presented in the Ways and Means release from September. And then there was no mention of carried interest in the House legislation from November. Carried interest, of course, hot topic. It has been debated by Congress since at least the mid 2000s. And we didn't see any real legislative activity on carried interest until the TCJA and the enactment of 1061. So section 1061, you may know, extends the holding period requirement for long-term capital gain associated with carried interest. So if you have a carried interest, gain associated with that interest will only qualify for the preferential long-term capital gain rate if you have held the interest or the underlying property giving rise to the gain for at least 3 years. There is an exception in those rules. They're quite complicated, but there is an exception from a part of the calculation in the rules that generally benefits taxpayers in the real estate industry. And that, was received favorably by those taxpayers. So in the September release from the Ways and Means, we saw sort of a paring back of provisions, TCJA provisions that were viewed by some as overly generous. And I think there was a view that 1061 didn't go far enough to curb benefits associated with carried interest. And so the September release proposed an extension of the 3-year holding period requirement to 5 years. And additionally, that proposal would change the way that we start the holding period clock. So under section 1061, as we know it now, our typical usual historic holding period rules apply. And people know sort of when to start the clock, but the Ways and Means release from September would change the computation of holding period. And I think the effect of that could be that it actually takes more than 5 years to hold an asset in a way that would qualify for the 5-year holding period requirement in the September release. So there still is an exception for certain real estate industry participants in the Ways and Means release from September. So they would have to have a 3-year holding period rather than the 5-year that would apply to most other taxpayers. So I think when the September release was presented, there was a feeling that, obviously a taxpayer would prefer a 1-year holding period to a 3-year holding period. But, I think taxpayers generally felt like it could have been worse. But it turns out it could have been better, because then we get to the BBBA in November. And there is, as I said, no mention of carried interest. So I am not sure what is going to happen with carried interest. Senator Manchin has said that he doesn't like carried interest. There was a memo that sort of circulated in October, I believe, and it was dated at the end of July, purportedly signed by Senators Schumer and Manchin, and it purported to outline a framework for the reconciliation bill that they both would agree to, and in it says, and I quote, "end carried interest." So given that, I don't think that Senator Manchin's constituents are terribly concerned with preserving carried interest benefits. Given that Manchin has said, again, he doesn't view the House legislation as his starting point, I suspect we will see carried interest, again, reform, if you will, or an amendment to section 1061 coming in any reconciliation that ultimately is enacted. With respect to, and of course, I mean, that carried interest features prominently in funds, private equity, and to the extent that those provisions change, that will of course have a ripple effect on M&A activity in that sector. Interest expense limitation, section 163J, that also is a product of the TCJA, and it generally provides that a taxpayer is only allowed to deduct net business interest expense to the extent of 30% of its adjusted taxable income. And this provision, as Mike indicated, it applies to most taxpayers, not just partnerships. It certainly does apply to partnerships in a very complicated way, but 163J is important for most taxpayers that have debt. So as drafted and enacted as part of the TCJA, we determine adjusted taxable income or ATI in a way that is akin to EBITDA. So more particularly, we look at taxable income and then we add back deductions for depreciation and amortization. And then we have our pool and a taxpayer is permitted to deduct net interest expense equal to, in an amount equal to 30% of that pool, if you will. So this concept that ATI is akin to EBITDA is only temporary. And in fact, it expires at the end of this year. And it is replaced with an EBIT concept, meaning that beginning in 2022, when a taxpayer is determining, its pool, 30% of which it can deduct net interest expense, it is no longer permitted to add back to taxable income depreciation and amortization. So that means that, a taxpayer for whom depreciation and amortization are significant items, its ability to deduct interest expense just got smaller. It's the limitation is even more narrow beginning in 2022. So when the TCJA was enacted, there was a lot of discussion about losing the DA, if you will, this depreciation and amortization component of EBITDA, and that spawned the Save the DA movement, if you will. And there was a lot of discussion about how this impacted industries, how it would in fact impact M&A activity, and I think there were some concerted lobbying efforts at the outset, and then that sort of waned, and I think it picked up again this year as people approached the coming end of the EBITDA concept for this purpose. There has been legislation proposed that, separate from reconciliation, that would maintain the current EBITDA definition for adjusted taxable income. I'm not aware that is going to be advanced as part of reconciliation or otherwise this year. I did a quick search before our panel just to see what people were writing about this, and people are still sort of submitting comments as recently as last month. Again, talking about how the impending change from the EBITDA standard to EBIT will negatively impact the economy and M&A in particular. But again, I'm not aware that is something that is meant to be fixed. Apparently, this was interesting. I thought this happened because the House originally proposed to use the EBITDA standard on a permanent basis. The Senate selected EBIT, and in conference, the compromise was to allow EBITDA through 2021 and then to revert to EBIT.
And Nick, there's a very, very complicated state and local dimension to this issue, isn't there?
There is, yeah. So if we back up a second, right, we think about what do states do with any of this federal tax legislation, right? How do they deal with it? There's basically three kinds of states, and I'll talk about them briefly. Most states are going to adopt some version of the Internal Revenue Code, and the first group of states we call rolling conformity states, and that means that they adopt Internal Revenue Code changes as soon as they're passed. So Build Back Better, it's not going to, but if it got passed tomorrow, that group of states would adopt everything that came out in that bill, in that law, automatically. Pennsylvania is a state like this, Delaware, New Jersey. And unless they pass legislation to the contrary, they adopt everything. And so back when TCJA happened, Pennsylvania automatically adopted it for corporate income tax purposes, not personal income taxes. By the way, Pennsylvania is a different kind of state for personal income tax purposes. They adopted TCJA for corporate income tax purposes, and then the legislature had to go back and pass a law to decouple from full expensing, that 100% bonus depreciation. They don't like that. So they had to go do something for that, right? The next group of states are called what we call the fixed date conformity states, and they fall into two buckets. One is the states that are fixed date conformity, but they update their conformity every year. So like Georgia, for example, will say on some date after the law is passed, they'll say we will adopt the Internal Revenue Code as it exists on January 1st, 2022, and that's what Georgia does, and they do that every year. The next group of states will be the states that are fixed conformity states. They don't adopt it every year. They don't change their law. California is the biggest example of that kind of state. They say we conform the Internal Revenue Code as of January 1st, 2015. And then there's another group of states that are the other states, and they're the states that don't adopt anything in the Internal Revenue Code. They may have some language in their statutes that adopt certain parts or adopt certain language, things of that nature, but they don't adopt it at all. Mississippi is the one example I always give here. And again, Pennsylvania for non-corporate tax, personal income tax purposes, Pennsylvania is in other states. Why this is important is for a couple reasons. If you think about it from an M&A lens, right? So companies do all kinds of different restructurings relating to, let's say 163J. Let's say, for those of you who know that the deemed repatriation event that happened in 2017, companies that are multinational companies will do restructuring to get that money back to the U.S. or to take advantage of the 163J limitation. And what they would want to understand from a state tax perspective is, do the states adopt those provisions? And the answer is some states will and some states won't. And then to Mike's point, you turn to 163J and you say, what do I do with that? I think, for those that don't know, states fall into two buckets here for filing purposes. Some states make you file a group return. We call it combined, not consolidated, because we have to be different because we're state. And then another group of states call it separate. They file separate companies. So each separate entity files a separate return. They don't file a consolidated return. And so for federal purposes, the federal government only cares about your consolidated group for 163J purposes. They don't care about each individual entity. They don't care about interest between two subsidiaries that are domestic that file in the same federal consolidated return. But separate company states may. Pennsylvania might care. Tennessee might care. So the states had to come out with guidance and say, how do you deal with that? So Pennsylvania came out with a notice back in 2019 that said, for example, this is the Pennsylvania example, and it gets really complicated, but they say, if you didn't have a federal consolidated limitation for 163J purposes, you don't have one for state. If you did have a limitation for consolidated return purposes, for federal purposes, you have to calculate separate limitations for each company that files in Pennsylvania. That's kind of complicated. And so what you think about in this context is if there's two things. One is that complexity, and number two is if there are changes to 163J or 162M or any of the other things that Debbie and Morgan talked about, how the state's going to treat those things and how complicated will it get. And when I'm going to go buy a company, did that company do those things correctly? If I'm going to do some kind of restructuring from an M&A perspective, do I need to take those things into account to make sure I'm not doing something wrong or tripping up some state tax? And there's plenty of horror stories I have of, hey, Nick, we're going to do this thing. Is there any state tax issues? Yes, there are a lot of state tax issues. And then they got to press pause and figure those things out, right? So, yeah, Mike, there's a lot of different issues that come out associated with these kinds of bills.
I know, and a question, Nick, that I'm sure you ask yourself and I ask myself so frequently is, does it really have to be this complicated? But then, how do you make it simpler? And if you make it simpler, well, it's gonna cost somebody money, or it's gonna cost the state money, and that's a pretty big driver of what happens in these types of instances. No, that's great. So let's go back to you, Debbie, and maybe talk a little bit about executive compensation, or the deduction of for at the corporate level for executive comp, because this is another kind of in the weeds issue, and then we'll start getting back to a higher level after this one.
Sure. So executive level compensation, right? So 162M is the code section that governs this area. And basically it's a limitation on the deduction of excessive employee remuneration. So under 162M1, right, a deduction is limited to $1 million generally, and applies to compensation paid to covered employees, which is your principal executive officer, your CFO, and then the three most highly compensated officers. However, right, TCJA came in, and it removed, there was an exception for performance-based comp that used to not be subject to that $1 million limitation. So the TCJA came in and removed that. And there's a transition role to help ease the pain a little bit. And it also changed who is a covered employee. And so basically it said once someone is designated a covered employee, they're always a covered employee. So even if they're no longer one of the top paid executives, because they were identified maybe last year in 2020, for example, they're covered, they're always going to be covered. And so they need to be subject to that limitation. And then the American Rescue Plan Act, it expanded the set of applicable employees that are subject to this limitation to include the 5 highest compensated employees, beyond what was already covered by the 162M, and that begins in tax years after 2026. So what does this mean, right? From an M&A perspective, here's where I know I tend to look at it. So there are final regulations that were issued in December of 2020 that basically term, covered employees includes the covered employees of a predecessor of a publicly held corporation for a preceding tax year, beginning after December 31st, 2016. So, and among other definitions of a predecessor, right, at the time, there were proposed regs, came out with a definition that if an acquirer corporation acquires at least 80% of the operating assets of the publicly held target corp, then the target corp is considered a predecessor of the acquirer. The final regulations that came out maintain that role, and they do clarify that the operating assets for purposes of that test refer to gross operating assets and not net operating assets. So how does this affect M&A, right? Basically, we have affected transactions that you need to look at. The predecessor rule in the proposed regulations is broadly applicable to several different types of corporate transactions. Basically, you could have it with respect to corporate reworks, corporate divisions, stock sales, asset sales. So you really, the result from accounting for a target's covered employees is a common part of the due diligence process now. And representation and warranty requests for transactions involving public companies is more common. If in connection with an affected transaction, such as the rework or the division or asset sale or stock sale, if a public company becomes obligated to pay covered employees of the target, right, any substantial incentive compensation or retention or severance, in the year or two after the acquisition, such like a retention bonus or a change in control payment, then these payments are largely no longer deductible. So to the extent that the parties in the transaction agree to allocate the cost of those liabilities to the sellers or the target via purchase price adjustment, that's a big consideration. Acquirers, people doing the acquisition, the buyers may want to consider how the loss of that deduction rate needs to be accounted for. Basically, at the result is, at least what I'm seeing, companies that are acquisitive, they need to be prepared for the possibility that a number of the covered employees essentially is going to grow as a result of these rules. So it's a lot to think about as you're going through the agreements and negotiations.
It's probably a bad analogy, and thanks for that, Debbie. But it's kind of like a virus. Who is a covered employee? Sorry. So that's great. Now, and those are some of the detailed provisions, and maybe we could take a step back here, and the next two, Nick, maybe you could talk to us about those, because these are things that, regardless of whether there's going to be tax reform might make them a little more complicated, but these are issues that every M&A tax lawyer deals with every day, no matter every season. Issues for all seasons. So, Nick, maybe you could walk us through some of the things that you've seen on stock versus asset and successor liability, and actually are kind of related topics.
Sure. Yeah. Thanks, Mike. So, a couple terms to just keep in the back of your mind to think about, right? So we talk about stock deals and asset deals. There's also what I guess I call deemed asset deals, which are when you buy something that's not a corporation or not legally asset. So like a partnership and S corporation, that's another piece that's out there. Another thing you should think about is we talk about buyers and sellers. We also talk about targets, which are the entity you're buying. And so when I use those terms, I just want to make sure everybody knows that that's the terms, and we're all going to use them, I'm assuming. And so just make sure everybody knows that. So the first thing you think about in stock and asset deals is, and in special liability, is that there are two parties. There's the seller and the buyer, and they care about different things. They also care about the same things. They may care about the same things. They care about different things too. So I'll kind of walk through what I think that the sellers and buyers care about in each of these things. And certainly, Debbie, Mike Morgan, if you have something to add, please jump in. But in the context of a stock deal, and a stock deal I'm talking about, you know, a company or person is buying the stock of a C corporation, a C corporation for tax purposes. The buyer and seller are going to care about successful liability, which we'll come back to in a second. When I mean successful liability, I mean who and what gets goes to the buyer in terms of what they have to pay for liabilities that were incurred by the company prior to its acquisition. It could be tax, it could be non-tax. We'll talk about tax, obviously, there could be non-tax as well. Both companies are also going to be concerned about something that's called a controlling interest real estate transfer tax. And I'll explain what that is as briefly as I possibly can. Many jurisdictions, especially on the East Coast, have real estate transfer taxes. If you buy real estate, you have to pay tax on it. The seller and the buyer usually share equally in the tax. Some jurisdictions, like Philadelphia, for example, said, we don't want people to put real estate in a company and then sell the company to avoid paying real estate transfer tax. And so when you sell an entity that owns real estate, and there's a lot of different other factors that go into play, it's not just that they own real estate, we may care about transfer taxes. My firm, we always address transfer taxes in any deal we do. And so that's important for both the buyer and the seller. So what does the buyer care about in a stock deal? They're going to buy a stock in a C corporation. What do they care about? And then this is no particular order. They care about attributes, tax attributes of the company they're purchasing, net operating losses. They care about 163J, interest carry forward limitations, or interest limitation carry forwards. They care about credits and incentives that the company may have they're buying. And federal law provides some limitations on what you can use post-acquisition from a C corporation. Section 382 is the Federal Internal Revenue Code, and the states have limitations as well. They may have additional limitations to what federal does, or they may have different limitations or no limitation at all. How does buying this company affect my tax profile? Does my federal consolidated group change in some fashion because I'm buying this company? Do I think this company's going to have losses in the future? Does that affect me in some way? How does the company affect my state tax profile? And I won't get on the details of how it could affect your state tax profile. If we had another 2 hours, I could do that, but I don't, so I won't. And one other thing to think about if you're the buyer is, if I'm going to use debt to acquire this company, where do I put the debt? What company gets the debt? Is it the buying company? Is it the company I purchased? Is it both? Who goes on the agreements? And that matters for tax purposes because those companies will get the interest deductions on the debt. And so that could benefit you from a federal and state perspective, depending upon which entity has that interest deduction. Okay, stock deal. What do the sellers care about? A couple different things. So how do I treat the gain or loss I have on the stock for federal and state tax purposes? Does it, and state gets a little complicated. Again, I won't get into that, but how do I deal with that? How do I put on my return in those situations? Something I always appreciate is stock basis. What's my basis in my stock I just sold? And for federal purposes, it's pretty complicated if you're a consolidated group. You have to make all these consolidated return adjustments to your basis to figure out what your basis is. For state purposes, in most states, you don't have to make those adjustments. It becomes very tax 101, right? It's my basis in the stock is what I paid for, or it's what I put into it, or what I took out of it that's not earnings and profits, not dividends. And so you get these situations, in my experience, where you have different stock basis for federal purposes and state purposes, and that can provide you some complexity and some benefit potentially as well. That's kind of the stock deal things to care about. I don't know if Debbie, Mike, or Morgan, anything to add on the stock deals before I jump into asset deals.
The only thing that I would add is exactly what you said, right? Some of those attributes with it, you get the benefits of some of those, but you also get the liabilities, right? And so from a due diligence perspective, or M&A, a buyer definitely wants to make sure they kick the tires, so to speak, on what those potential liabilities are with respect to the tax footprint, especially, right? Because you're buying the stock of the company and you are now on the hook for it, subject to certain ways you do that. You cover those liabilities, whether you put some protection in the agreement, or you do representation of warranty insurance and so forth.
Yeah, and maybe it might help if I talk about that a little bit before we go back to that topic, successor liability. So like Debbie said, when you buy a company, you're inheriting the good things and the bad things of that company. You're inheriting their tax attributes, that you're inheriting their business, obviously. You're also inheriting anything they did wrong from a tax perspective prior to the acquisition. That's just the way the law works. And so you're going to inherit those things. So like Debbie said, you're going to want to do tax due diligence and other due diligence on that company before you buy it. So you can identify those things and put them in the agreement or say, here's how we're going to deal with them or whatever that is. And that's what successor liability means. Successor liability can also attach for certain taxes in certain states and maybe federal too, in the context of asset deals, both legal asset deals and deemed asset deals. And that's maybe I'll jump into that now. So a lot of our, one thing, so legal asset deals, when I mean by legal asset deals, you're going to sell tangible property, real property, and or intangible property from an entity to another entity, like a standard sort of legal asset sale, legal asset transaction. What do the buyer and seller both care about? Well, number one, they care about successor liability, which we'll come back to again. You may say, Nick, we don't think there's successor liability in asset transactions. Well, there could be, especially for state tax purposes. We'll come back to that. Both sides are going to care about successor liability. They're both going to care about sales tax. So when you sell assets, there could be a sales tax you have to collect from the purchaser, and the purchaser has to pay the seller, and the seller has to give to the state on those transactions. Now, most states have what we call occasional sale exemptions, which are basically saying that if you make a sale that you don't, of things you don't normally sell, right? Like I sell widgets, but I'm going to sell my machinery and equipment to make the widgets. I'm not in the business of selling machinery and equipment that makes widgets. I'm in the business of selling widgets. So the sales tax will not apply to that sale. But not all states have that rule. So you have to make sure you understand which states have that rule if you're going to do an asset sale. Real estate transfer taxes. I talked about controlling interest real estate transfer taxes. If you actually sell real estate transfer taxes will likely apply if the state has those types of taxes, and the buyer and seller both care about that. It's going to be cost to both of them potentially. Okay, in the legal asset deal, what does the buyer care about? The buyer cares about what kind of due diligence the seller will let them do on the assets they're buying. Again, that relates to successor liability. I've been in many deals where it's an asset deal and the seller says, we're not going to show you our tax return. You're not buying our company, you're buying assets. And I have to come back and say, well, I do have successor liability for sales tax. So you see your sales tax returns, and that usually works itself out. If you're a buyer and you buy assets and you buy into an existing company, well, I guess the first question is, you're going to buy an existing company or a new company? You're going to form a new company to buy these assets, or you're going to buy an existing company? Either way, how's that going to affect your federal and state tax profiles for that entity or that group, right? We, from a state perspective, for example, we say, does the assets you're buying going to generate income? Are they going to generate income? If they are you putting them in the right entity, or do you want to have them in a different entity? So you kind of think about that from a planning perspective. Another thing you think about, and the seller cares about this too, is a lot of times assets, let's say, for example, let's give this example. You're going to sell, your seller, you built this plant in Illinois, and you got property tax abatements and maybe a low interest loan from the local jurisdiction that you built the plant in. You're going to sell the plant and all the employees to a new company. Is there anything in the incentive agreement you came to with a local jurisdiction that prevents you from doing that? Or will the local jurisdiction claw back or take back those benefits they gave you because that agreement says you can't sell or do anything with this property for 5 years? So something that both the buyer and seller care about as well. Last thing on this, the seller is going to care about their asset basis in their assets, right? What's my basis in my intangibles selling? What's my basis in the real property I'm selling? Things of that nature. And they'll care about that. And again, that's another difference that exists for federal and state purposes. How much is my asset basis could be different for federal and state purposes as well. Last one is going to be deemed asset sales. So buying, selling a partnership, selling an S corporation. For federal purposes, that's treated as an asset deal, and state income tax purposes usually treated as an asset deal. And so, in my experience, in most instances when we're doing due diligence on a partnership, the federal team will sort of step aside a little bit and let the state team take over. In S corporations acquisitions, the federal team want to know if there's a valid S corp election, right? That's the big thing they look at. But they're really treated as asset deals for income tax purposes. They are not treated as asset deals for any other tax purposes. You're buying an entity. So for those of you that know state taxes, right, if you have a partnership or a single member LLC or an S corporation, the incidence of tax for sales tax, property tax, payroll tax, unclaimed property, et cetera, is on the entity, not on its owners, right? Income tax is on its owners, but for non-income taxes on the entity itself. And so when you buy the entity, the partnership, the S corporation, the single member LLC, you care as a buyer about sales tax and property tax and those types of things. And so you're going to ask about those taxes in a due diligence context to make sure that you understand as a buyer, what am I inheriting? Because you're going to inherit those things for state tax purposes. You're going to inherit bad sales tax exposure from pre-acquisition periods for the partnership you're buying. It's an entity level tax. A lot of the things that I talked about from an asset deal perspective, a legal asset deal perspective, apply here on a deemed asset deal perspective too. The only other thing I'll mention, this will get us into successful liability in a second, is for state income tax for partnerships and S corporations. This is something we deal with a lot. It's really complicated. I'll try my best to simplify it for folks. So I told you for federal purposes, the incidence of income tax is not on the partnership or the S corporation, it's on the partners or the S corporation shareholders. That's who pays the tax. For state purposes, that is not always the case. Many state jurisdictions have what we call non-resident withholding requirements. And so, for example, if I was a New York resident and I was a partner in a partnership that filed in Pennsylvania, Pennsylvania requires that partnership to withhold and pay my tax to Pennsylvania. And so what that means is Pennsylvania could say, if your buyer acquires that partnership and that partnership that they acquired did not collect or did not withhold and remit tax for me in Pennsylvania, Pennsylvania could and will come in and say, buyer, you're responsible for that tax now. Even though it's an income tax, even though it's really my income tax, it's really going to be the partnership's income tax too. And so we always try to look at, in the context of deemed asset sales, all those types of issues, not just sales tax, but also income tax too.
Those are great points. I was going to add one thing in addition to the state stuff that you mentioned that I know we look at in deals specifically is the payroll tax, right? So even if, like you said, you're buying a partnership or an S corp and there's no federal tax, the payroll tax is another consideration. How are they classifying subcontractors, right? Are they really employees? There's some state implications that come along with that potentially as well, because of the nexus of the company. But other things that I'm seeing more recently is related to COVID. Some of the provisions, right, the COVID related provisions, like under the CARES Act for the employee retention credit, for example. So you need to take a look if a company availed themselves of some of those benefits, even though they're related to employees per se, it's really a company liability, right? It's getting back payroll taxes associated with compensating those employees. And so if a company did, if you're doing due diligence on a company that took the benefits of those, you need to kind of kick the tires a little bit there too and make sure, was it valid? Otherwise you could potentially have that liability if it was found not to be.
We did get a question. I don't know if it's appropriate for me to answer it, but I can. Jim asked, if you're buying a company that's domiciled in one state, but at other locations in other states, you're having to go through the analysis for each state. And the answer is yes, right? And by the way, Jim, not just the states that they have locations in, every state. They could have a filing requirement in states they don't have locations. So we do a multi-state diligence on most companies. We don't go into a lot of detail on each state. It just takes too much time and would be too costly for our clients. We try to do as much high level as we can, but yes, we would do every state that they have potential operations in.
And Nick, I think we were talking about this a little bit earlier, that now with everybody working from home, or not everybody, but a lot of people working from home, the seller may have nexus for either withholding purposes or for sales tax purposes, or maybe for income tax purposes as a result of that they didn't have prior to COVID and people working from home, which adds just another layer of complexity and detail to look at in these types of situations.
That's right. If you ever look at an agenda for a due diligence call, when we have calls with target companies and their management, you'll see on there these days a bullet that says remote workers. And that remote workers bill covers a lot of different taxes, covers payroll taxes, covers sales tax, income, it covers a lot of different taxes. But we want to know, you're based in New York. Are your folks that live in Pennsylvania, and working from home now? And does that affect your tax profile from a state perspective? It can be a big deal. It can affect international too, for that matter, right? You can have people all over the place. Right. Maybe some high compensation employees going to live in Italy or something, or France. I don't know, but yeah, it could affect a lot of different areas.
So how does this, Nick? How does this then play into who has control over how these issues are resolved after the deal is over?
Yeah. So I've been doing this since 2005, and it's gotten to the point now where a lot of agreements will have specific provisions as to who gets to control or have influence over or take care of exposures identified in diligence. And I'll give you a quick example, not a real example, a fake example. You could do a due diligence on a company and find out that they owe $1 million of sales tax for pre-acquisition period. And what we used to see is like, okay, the buyer will take care of it, and there's different ways to take care of it. And the main way is we do something called a voluntary disclosure agreement, and we approach the state. We say we owe you some sales tax, and the state says, okay, we're going to give you a limited look back period. We're going to say 3 years of sales tax liability to 10, and we're going to waive penalties, right? So it's a win-win for both the state and the company. And so we a long time ago, we used to just do that, and the seller would pay for it, and the buyer would go and do it, and with some consultant to help them. These days, in a lot of situations, the seller wants to have control over that process. They want to be able to say, no, you're not going to do that, or yes, you can do that, but we want our tax advisors to look at what your tax advisors are doing so that we can approve or not what you're doing. And so you think about, Debbie talked about this a little bit, but you're going to have things in the agreement, if you're the buyer and the seller, that cover off who's going to pay for exposures. And so when the seller says, hey, I'm paying for the exposure, I need to have some control over that process. And so we see that a lot more now than I think we did years ago. And it does cause sometimes some parties to be at loggerheads, frankly, about what things are going to happen and who's going to do what. And I'm an attorney, but the attorneys get involved, not me, but real attorneys get involved. As my wife says, I'm not a real attorney, I'm a tax person. So those kind of things are happening more frequently in my experience than they used to happen maybe 10 years ago.
Right, because I mean, they could, the buyer and the seller could have different interests in what happens to the escrow, when the escrow is paid out, what's paid out of the escrow, how much goes into the escrow.
Yeah.
So
that's right.
There can be some very significant differences of opinion. Hey, thanks, Nick. Anything else you wanted to mention on those several issues?
Yes, but I don't have time. No,
no. We can talk about it all day.
I'd love to all day, but no. Let's get into sub K, I think.
Okay. All right. Yeah. Morgan, why don't you talk to us about a couple of sub K issues?
Yeah, so I'll start with the BBA. This is the Bipartisan Budget Act's partnership tax audit revamp, not to be confused with the BBBA, the Build Back Better Act. So, and this relates to what Nick was just speaking about. The BBA rules, they were enacted in 2015, they were effective in 2018, and they fundamentally changed the way that partnerships are audited and adjustments are paid and assessments are paid. And under the BBA rules, the general rule is that the partnership pays. So that was, a radical departure from TEFRA, the previously existing audit procedures. And so again, general rule, the default rule is the IRS audits the partnership. If there's an imputed underpayment and an assessment is made, then the partnership pays. And that means that the persons who are partners in the partnership in the year that the partnership pays the assessment, those are the persons that bear the economic burden of the liability. And that year, when an audit is concluded, when the adjustment is finalized, and when the partnership pays, that's called, generally speaking, the adjustment year. But we know that adjustments and audits relate to activity that occurred years earlier, generally. And so, an audit that closes in 2022 and for which a partnership pays an assessment in 2022 could well relate to activity that occurred in 2019. And so when you've got an acquisition and you're talking about an adjustment year that's happening post-closing with respect to a reviewed or audited year, that is a pre-closing tax year, then there very much are questions about who, not just who's going to control, but who's actually going to bear the economic burden of that liability. And in almost all cases, buyers and sellers are absolutely opposed. Their interests are absolutely opposed. So a buyer is not going to be terribly happy with this default general rule that says, even though this buyer was not a partner in my example in 2019, because in 2022, the partner is a member of the partnership and the partnership is paying in 2022, that partner is going to be indirectly burdened by the 2022 payment. The buyer's not going to want the general rule to apply. And instead, the buyer is going to want to apply an exception known as a push-out election. And the push-out election effectively means that the partnership's liability is pushed out to the reviewed year partners. So going back to my example, even though the audit would have concluded in 2022, if ultimately the partnership owes $100, the partnership would push that $100 liability out to the partners who existed in 2019, and they effectively would be on the hook for paying that liability. That's very hard logistically, because the buyer may have no idea how to reach these partners. I mean, it's difficult logistically, but conceptually, that's how it works. So a buyer is going to want to make sure that if there's an audit of a pre-closing tax year that is settled post-closing, that there is a push out election, and buyers increasingly are actually asking the sellers to commit to making a push out election if that situation arises. Sellers, on the other hand, would be perfectly happy with the general rule. They would be perfectly happy if the 2022 partners are burdened with their 2019 partnership liability. And whether that's right or not philosophically is a different question, but generally sellers would be okay with that outcome. Sellers also don't want to have their hands tied. So, oftentimes sellers are going to resist a request by the buyer that they commit to making a push out election. So it's absolutely a negotiated point. Another key feature of the partnership audit rules is the partnership representative. So you may be familiar with the TEFRA analog to the partnership representative, or the PR, known as the tax matters partner, or the TMP. Though they're roughly similar conceptually, the partnership representative has far more power, authority, discretion than a TMP ordinarily does. And in fact, the partnership representative is the sole person who deals with the IRS and audit, and in its sole discretion, it can settle, it can agree to extend statutes of limitations, it can represent the partnership in its sole discretion, and everyone else is sort of along for the ride, whether they like what is happening or not. So in a negotiated transaction, if a buyer is coming in going to be a member of a pre-existing and continuing partnership, it's going to be very important that the buyer understands what the operating agreement says about the partnership representative, who it is, and whether non-partnership representatives have any notice and consent rights. For example, they won't have any rights with respect to the IRS and the audit, but hopefully they will negotiate some notice and consent rights that at least would give them some recourse as a contractual law matter. So really two key negotiating topics for buyers and sellers: what's going to happen for post-closing audits, and what are the buyer's rights with respect to audit proceedings, assuming they are not the partnership representative. There's one more point I wanted to raise. If Nick talked about, a sale of 100% of a partnership and how that's a sale of assets, that when a purchaser buys 100% of a partnership, the partnership ceases to exist. And there are special rules in the BVA procedures that generally dictate what happens when your partnership ceases to exist. And they generally say that the former partners, the sellers, are going to be the ones who are going to bear audit assessments relating to pre-closing tax years. But there is uncertainty, especially when you do something more exotic, like a partnership merger or a partnership division. So partnerships ceasing to exist it's sort of a hot topic under the BVA. Last but not least, because I see we're running out of time, As others mentioned, this is a lot of this is a diligence exercise. Because we now have these very complicated and highly articulated audit procedures, and because there's a lot of uncertainty, I mean, they're only now being tested. That just puts more emphasis on the importance of really diligencing the seller's tax positions, because as Nick said, in many respects, the buyer is going to inherit those and is going to have to deal with the IRS, to the extent it audits those positions going forward, and under the BVA or otherwise, it may have some liability. The other topic, I think, for me on the subcase side relates to profits interest, and I will cover this quickly. Profits interests are a very, very hot topic for me. And actually this week I have 3 matters with 3 different clients that all of them relate to profits interest. A profits interest, I mean, we talked about it already when we were talking about carried interest. That's a type of profits interest. The profits interest is an interest that is granted to a service provider, and it gives the service provider a right to share in future asset appreciation and gain, and potentially future income. Future meaning income and appreciation accreting after the date the profits interest is granted. And it's a form of equity compensation. And it's very popular because, employers and companies like to be able to give their employees equity comp. But this particular type of equity comp generally is tax-free on grant, assuming requisite hoops are cleared and jumped through. And also, like in the carried interest context, the holder of the profits interest has an opportunity to realize value from the profits interest as capital gain taxable at preferential rates. So it is definitely not the case that if you hold a profits interest, you only realize capital gain. That is not true, but it is very much unlike a stock equity compensation situation where you are going to have ordinary income as a matter of course. 2 things to really keep in mind when you're dealing with profits interest. In order to sort of clear those hurdles and jump through the hoops I alluded to a moment ago or spoke of, you have to be very careful and deliberate in your operating agreement to ensure that the profits interest holder is not going to share in any existing asset value. Just make sure that they are in fact only going to share in post-grant appreciation, income, and value. The other thing that comes up a lot is sort of a structuring analysis that is a result of the IRS position that a person cannot be both a partner in a partnership and also a W-2 wages employee of that partnership. It's often referred to as the dual partner and employee rule. You just can't, the same person can't be both. So if you have an operating partnership that employs Debbie, for example, and is paying Debbie W-2 wages, the management of the partnership may say, Debbie's awesome, and we really want to give her a profits interest so she can begin to share alongside the other equity members. That would mean in that case that Debbie would be both a partner in the partnership and a W-2 wages employee, and that's not permitted under existing and quite old IRS guidance. So if you find yourself in that situation, there are sort of well-known in the marketplace structuring alternatives that are intended to mitigate that situation, that dual partner employee status. So just know that, and if you focus on that and making sure you get your profits interest in a place where they're only sharing in future value, you'll be 90% of the way there probably on making sure you've got a good profits interest for your employees.
Wow. I'm glad that there are people like you who deal with these things. That's complicated. I'll tell you what, why don't we, before we have, actually, before we go back to Nick, maybe I can ask again whether there are any questions that you'd like to throw out to our panel other than the one that Nick already addressed. And I'll tell you what, if anybody's typing one or wants to ask one, Nick, why don't you take us home? And because we know state and local tax is always the most important aspect of any transaction.
Right, Mike. So the first two things on state and local tax we'll go through, and again, these are not all the issues, but they're two that we see pretty frequently on deals. So the first one is sales tax exposure, and it's important, and we see it on every deal for a few reasons. Number one is, as a mentor of mine used to say, 8% of gross is always material. So I've never seen a deal die because of anything other than sales tax. And if a company's not supposed to be paying sales tax, is not paying sales tax, 8% of gross is always material. And so that's number one. Number two is, back in 2018, before 2018, in order for a company to have to collect and pay sales tax, it had to have a physical presence in the relevant state. There was a Supreme Court decision in 2018, Wayfair it's called, that said, you know what, we're reversing course on this. And they said, you don't need to have a physical presence in the state. You can have an economic presence in the state. You can just merely be making sales of a certain amount of dollars or a certain number of transactions, and you can have a sales tax filing requirement. That broadened the potential number of states at issue. And number three is the determination of whether something is subject to sales tax or not is very complicated. And if you think about, state statutes, most of which were written 50 years ago, that were dealing with the economy 50 years ago, when all we did was manufacture and sell products. And then you think about the economy today, where we not only just manufacture and sell products, we manufacture and sell or deal with services and software and platform as a service and software and all these different terms we throw around there for different technology that we have now. The sales tax implications of licensing software or selling information or those types of things becomes very complicated. And so when you're looking at a target company that may not be sophisticated from a sales tax perspective, you can find a lot of issues on that and a lot of things that could be potential problems. The last thing on sales tax I'll mention is, as a general proposition, states that have sales tax say that retail sales of tangible personal property are subject to sales tax. If a company sells you go to Walmart and buy a widget, Walmart's going to charge you sales tax because they're selling it to you for your use, and you're going to use it, and they charge you sales tax. If I'm selling Walmart a widget that Walmart's going to sell to you, that's going to be exempt from tax. It's going to be a sale for resale. My transaction with Walmart is a sale for resale. Every single state that has that exemption, and they have a lot of different kinds of exemptions, that's just an example, will require me to collect from Walmart a sales tax exemption certificate, a resale exemption certificate, a document that says Walmart's purchasing the widget to resell to somebody else. 10, 15 years ago, if I got audited by a state and said, I'm selling to Walmart and I don't have an exemption, I do not have an exemption certificate, the state might go away. These days, the state's not going to go away anymore for the most part. They're going to say, no, you don't have an exemption certificate. I'm saying, well, I'm not selling 3,000 widgets to Walmart so Walmart can use them. They're going to resell them, and they're going to say, we don't care. This is the other issue we see in a lot of deals is companies that do not collect exemption certificates from customers on exempt sales. And we know they're exempt sales. We know they shouldn't be subject to sales tax, but we still have to tell our clients, our buyers, you guys need to look at this and really think about whether you want to buy the company, whether you want to put up some kind of escrow or purchase price adjustment or whatever, because they don't have exemption certificates. Now there's ways to remediate that, but that's been a big issue on a lot of deals for me in the past 10 years.
Nick, actually, before you leave sales tax, Nick, I want to throw something on and see whether you've seen it, but I know that particularly in Illinois and New York, there have been a number of either class action suits or qui tam suits. And the class action suits allege somebody like Walmart, for instance, Home Depot, Lowe's, those were the defendants in one of these cases, where, like you said, it gets very, very complicated. I install carpeting, for instance, that was the issue with Home Depot and Lowe's in Illinois. And are those installation services subject to tax? Well, if Home Depot or Lowe's gets it wrong and doesn't charge tax, there could be what's called a qui tam suit, where somebody outside the state steps into the shoes of the state and says, hey, Walmart, Home Depot, whatever, you should have been collecting tax and you weren't. And now not only are you subject to that tax and interest and penalty, but now because of the way the laws are drafted, you might be subject to treble damages, have to pay 3 times that amount in damages. Yeah. On the other side of the coin, with the class action suits, where somebody, for instance, it was Papa John's in Florida, where they were charging sales tax on pizza delivery services, and they had information from the state that indicated it was not subject to tax, but they were taxing it anyway. And so now the class action is formed, and they sue, and again, potential for treble damages, and say, hey, Papa John's, you overcharged me sales tax on this. And so it's not just when there's an undercharging of sales tax, but an overcharging. So I think it just gets much, much more complicated. And last thing I'll just throw in here, Nick, is that you mentioned what is subject to tax. Absolutely, that's a big issue. But in addition, well, where are you selling these services that may be subject to tax, and you're selling them to a server in Virginia, but then they're used in 18 other states? How do you apportion that sales tax? So it gets really, really complicated.
Yeah, like I would give the example when I teach different classes, like, PwC will buy Microsoft products, right? We use Microsoft products at PwC. Our headquarters is in New York, but I'm not in New York, and I'm using Microsoft products. How does Microsoft figure out? They do, by the way, but how do they figure out where the products are being used when there may be some opaqueness between that. Those great point. Last thing quickly is unclaimed property. So for those of you that don't know, because I think there's a lot of people that don't know what unclaimed property is, it's unclaimed property is things that a company gets that's not their property. So for example, if I used to work at a supermarket when I was in high school, Giant Foods would give me a paycheck. If I never picked up a paper paycheck, by the way, if I never picked up the paper paycheck, that's not Giant Foods paper paycheck, that's my paycheck. And so what Giant's required to do is give that paycheck to the state so that the state can hold it for me. I'm using air quotes, so I can go get it someday, right? And that's called unclaimed property. There's a lot of different things: vendor credits, deposits that you get from customers. Those types of things can be unclaimed property once they sit for a certain period of time. And companies are supposed to file unclaimed property reports with states and report the unclaimed property and pay it over to the state, so that the state can hold it for the individual or company to go get it at some point. And you can find these things on Secretary of State websites, I believe. Delaware makes a ton of money on unclaimed property. I think it's their second highest revenue generation is for unclaimed property. Many target companies that I look at do not file unclaimed property at all, and they will have unclaimed property, but they will have different ways that they think they can deal with it. But it's still another issue that companies don't get right. I mean, they're not. Some companies don't get right income tax or payroll tax, but the two things that companies get wrong the most are sales tax and unclaimed property. So it's always those two issues that come up on deals.
No, that's great, Nick, and thanks to Debbie, Morgan, and Nick for your valuable contributions and sharing your insights for us. Before we sign off, does anybody have any parting comments? 30-second lightning round on what they would view as maybe the most important issues in their particular area of expertise. I'll start with you, Debbie. Is that all right?
Sure. I would say really, all of them, especially the pending legislation, that is key for when you're modeling out, right, an acquisition or a sale. You really need to figure out if you're buying assets or in a way that you can get, a step up and get the goodwill and the amortization on it. What tax rate is that coming in at, right? Those are the different things, and it becomes part of the negotiations, right? Are we getting a tax shield on something? Are we giving up something? So those are the key things that I know we look at closely.
Yeah, and actually back when I was at an accounting firm, I used to tell my clients, kind of like buying real estate, the three most important issues are model, and model. Morgan?
Yeah, no, I agree with that. I think I'm most focused on the pending tax legislation because I do expect that if reconciliation is enacted this year, I do think there will be provisions enacted that do impact partnerships. I agree entirely. I mean, the only way to know how the chips will fall is to model, because you take something like, imagine a structure that has both carried interest and 163J and many tiers of partnerships, and that is a real challenge to try to figure out what it all means. So yeah, and I don't think I mentioned this earlier, but Senator Wyden did And those who studied partnership tax with me this past fall know this well. He introduced really fundamental changes to the partnership tax rules, very sweeping changes. They are not going to be enacted as part of reconciliation or otherwise this year, as far as I can tell. But you know, those proposals are out there now, and I suspect they may come up again here and there. So I think the landscape is just, you know, since the TCJA, I think we've learned that to expect change, and you know, you have to just react to the change, understand it, and then figure out what makes sense going forward.
Thanks, Morgan. Nick?
I'm actually not going to talk about state tax. I'm going to talk about something that I think just we didn't cover, but just to make sure everybody knows. If you're a buyer or seller or an advisor to a buyer or seller, one of the most important things you should look at is the agreement. Make sure you look at the agreement. How does it deal with taxes? It's very, very important. So that's really my last one, Mike. That's all I wanted to say on that.
No, that's great. And that is a very, very important issue. Thanks again to all of our panelists, and Joy.
Yeah, you know, thank you so much. I am incredibly grateful that we have such experts as practicing alums and professors in our program who are helping to educate the next generation of tax professionals. Absolutely want to once again thank our panelists for sharing with us today. This is not my area of expertise, but I feel like this was so incredibly helpful for me in thinking about various ways in which I engage with our community. And I also want to thank those who are able to join us today for our webinar. And I encourage you to keep an eye out for more webinars in 2022. This is the last one for 2021. So I hope that you all have a great rest of your day, and that 2021 ends on a high note for you all. And I'll see you again in 2022. Thank you, everybody.
Thank you.
Thanks.